Good afternoon. My name is John Sengenberger. I am head of the Alumni Relations Office at the Tepper School, and we're so glad to welcome you to our panel discussion today on what's ahead for cryptocurrencies and blockchain. We're always happy to have you join us in our virtual classroom as part of our alumni lifelong learning program at the Tepper School. And we're also delighted to have alumni and students with us from across the campus. So thanks so much for coming and joining us. Special thanks to my colleague, Janice French, who is handling things for us as well. Before we begin, let me just share a couple of announcements of upcoming events that we have at the Tepper School. We have a number of upcoming webinars, including transitioning to the post-COVID economy, challenges and opportunities with our Tepper Executive Alumni Career Coach, Julie Thornton, that's coming up in April. We also have a number of other events. We have a webinar with our alumni from Google talking about staying productive in the virtual environment. That's also coming up in April. You'll get an announcement about that as well. And then we have two alumni speakers coming in our WMLN Speaker Series. Amit Shachdev, who is Executive Vice President and Chief Patent Officer and everything at Vertex Pharmaceuticals, is going to be talking. We also have Ted Decker from our MBA program, who is President and Chief Operating Officer at Home Depot. These are programs that are for our students and for our alumni community, so we hope you can join us for those. It gives us an opportunity to feature our alumni. And last, we have an upcoming webinar in May. Just wanted to give you an early head up on it. It's Jay Apt, Professor Jay Apt, who is co-director of the Carnegie Mellon Electricity Industry Center, teaches at the Tepper School on how reliable are the U.S. electric and natural gas systems. We know that's a big issue now with all the experiences we had in Texas this winter. So upcoming events for us, but for today, we want to introduce our speakers in just a moment. But before I do, I want to also encourage you, if you haven't already made your annual contribution to Carnegie Mellon and to the Tepper School, we encourage you to do that. This is an important time for it. Thank you to all who are supporting the work of the university and helping us through this interesting time that we're in right now. Okay, now to our speakers. Professor Brian Rutledge is going to be our faculty host and moderator today. He's Associate Professor of Finance at the Tepper School and one of our Canadians on the faculty, as you can see. He joined the faculty in 1996. He's an award-winning faculty member. He received the George Leland Bach Teaching Award granted by our graduating MBA classes at the Tepper School in 1998 and 2004. He has a broad range of research interests, but he also teaches in almost all of our programs. He's currently teaching business science to our undergraduate business students. He's teaching in the core of the MBA program, finance track. He teaches financial economics for the MSCF program, the Alpha for one of our other programs, and has taught venture capital and private equity. In addition to all that, he teaches in our executive education program in finance. So glad to have Brian leading the charge today. Joining Brian will be three of our alumni experts. I'm going to give you a brief introduction for them. They all have impressive backgrounds, and we'll send you their LinkedIn profiles after the seminar today. First is Steve Ehrlich. He's Director of Research at Digital Assets at Forbes. So almost any question you have about digital assets, he's ready to answer that or direct you to that. He also has a background as a social media and copy lead at Kraken, a cryptocurrency exchange in the US. And before joining Kraken, he was the Chief Operating Officer at the Wall Street Blockchain Alliance, a nonprofit association dedicated to the adoption of cryptocurrencies and blockchain technologies across global markets. Before that, his industry background was with Spitzberg Partners, a boutique advisory firm, also with as a vice president lead strategy analyst at Citi in FinTech. He also spent 5 years as a special intelligence analyst at Booz Allen Hamilton, supporting the U.S. Department of Defense. He received his undergraduate degree at the Tepper School in 2004 and his master's in international affairs from Columbia University's International and Public Affairs School. So he's also certified as a information privacy professional as well. So lots of great things. We're looking forward to his comments today. Also joining us is Ron Papanek. He is head of data business at Symbiont. He's been a blockchain advocate since 2013 and is a frequent speaker on blockchain topics on financial services, government, and law. He's got a lot of experience in this area, and he'll be talking about that today. Prior to joining Symbiont, Ron led the America's Alternative Investment Analytics business at MSCI. And before that, he spent 10 years at JP Morgan Chase as a vice president responsible for market making and proprietary trading. He started his career in finance at the Chicago Board of Trade, where he had gotten his undergrad in BA in economics from the University of Chicago, and then his MSIA or his MBA in finance from the Tepper School of Carnegie Mellon. So glad to have Ron with us as well. And the third member of our expert team today is Liliana Rieser. She's from our MSCF program in 2004. So it's great to have three of our programs at the Tepper School and Carnegie Mellon featured in our speakers today. She is the founder and CEO of Superfin, based in London, England. It's a smart wealth tech platform for digital assets, including cryptocurrencies, that leverages proprietary investment and risk models for digital assets. She's an entrepreneur. She's got a lot of experience in this. She's a regular fintech and blockchain speaker and panelist and judge, and one of the leading people in the field, one of the top women in fintech right now. Prior to becoming an entrepreneur, she worked in the fintech and investment banking space at JP Morgan, Bank of America, Deutsche Bank, Morgan Stanley, and Moody's Analytics, both in the US and in the UK. She comes to us with her MSCF, her Master's in Computational Finance from Carnegie Mellon University, and an MBA from UCLA. An impressive group of alumni for us today. Now let me hand the reins back over to Professor Rutledge, and we'll get started with our webinar today. Thank you.
Thank you all and welcome. I watched that picture of me go past and I realized there's pre-pandemic hair and post-pandemic hair. So I'll try and not make myself too large on your screen as we chat. Anyway, thank you. Welcome. It is good to have you here. I have two duties before bringing everybody in to chat. One is I wanted to see if we could do a quick poll across everyone to see. We have two relatively easy yes/no questions for you. The first one I'm going to ask you is mine. You will recognize it because it looks like an exam question, which is Bitcoin money? It's been around since 2008-ish, and I am watching the answers come in, and oftentimes this one is good for an opening discussion because it is about a 50-50 chance that people will say that Bitcoin is money, and you guys are not disappointing. We currently have the yeses are nudging out the no's by 54-46. So I think that highlights a lot of what you see in sort of the uncertainty around this space, which is this useful? Maybe yes, maybe no. Bitcoin is one that was sort of initially designed as a new currency. Has it succeeded? And I think we've all concluded we got a firm maybe. So 50-50. So here's the end of the poll. Share those results. Everybody see those results? The 55-46. Oh, sorry, 55-45. Yeah, I didn't give you a maybe question, by the way. That was by design. You're on this side of the fence or that side of the fence. There's no on. Here's the second one out of curiosity. This one is a bit more factual. This is a yes, no, unless you want to debate about what it means to invest, what it means for cryptocurrencies. You are a more risk-seeking type than the average American out there or average person out there. We are 40% at the moment into cryptocurrencies. So it's got 40, 41, 59. And might I just compliment you all on your speed of voting? I think that is an impressive quick reaction time to that. All right. That also, I think, speaks to some of the uncertainty around cryptocurrencies and blockchain. So here's a slide that, sorry, stop sharing the results. Close that. Here's a slide that if you took venture capital class in 1999, you might have needed. I probably used this. This is Wally, the engineer. Venture capitalists have arrived to give Wally a big pile of money. because he's got a web-based business. I don't have a web-based business. I'm only an engineer with a cool ponytail. That's good enough for me. We'd like to get in early. The beauty part of this cartoon is it is ever fresh, right? In the sense of there is a lot of excitement and innovation hovering around the blockchain space that's going. And I was thinking that this panel initially was thinking about happening a year ago, and even in just the past year, setting aside the nuttiness that has put us all working from home, our discussion now is going to be quite different than it was a year ago. It's fast changing. So let me do this before I turn it over to people who know more than me, which is how would you define what it is we are talking about? Because lots of things that are new and a bit blank canvas, sometimes we are pinning our hopes and dreams on a new technology that is perhaps our hopes and dreams and not necessarily related to the new technology. But here's how I think about the sort of three key components of what makes a blockchain different from what we might have had before. So the first bit is it's a ledger, where I mean it is an ordered sequence of transactions. So a place where keeping track of data and data in an order is important. The most obvious ledger you would think about is accounting. And so the fact we are calling blockchain people who add transactions to the blockchain miners is marketing. You and I might call them accountants, but that might not be as exciting for undergrads in computer science. But it is a ledger in the sense of it's just keeping track of an ordered list of transactions. The obvious one is like your bank account. But of course, there's lots of databases where you think about keeping track of the order in which information arrives is important. Like Wikipedia, for example, a list of edits. The Word document you sent around the office for editing, same idea. The key innovation of blockchain is it is decentralized. There is no arbiter of truth in blockchain. It is designed to be, right? Sometimes you describe it as it's accounting without an auditor, right? And like as a former accountant, that's really terrifying. So you're just putting transactions out there and people are writing them down, and somehow we hope that these transactions attain some consensus that we agree they happened and some permanence that we agree that they remained in the happened state. And then the last part that I think is important is understanding the competitive forces that are behind the decentralized ledger. That is the people that are incentivized to create and maintain this ledger. Is that sustainable? Can we write them down in the future? Okay, with that, I wanted to just say how this connects to the Tepper School of Business and Carnegie Mellon in general. And you won't be surprised to know that Carnegie Mellon is all over blockchain, and the Tepper School of Business is as well a deep part of sort of blockchain cryptocurrency research. In part, it comes from when I teach my business science folks, I have sort of two axioms for them that we rely on as we go through. And the first is that business problems are not just business, that you cannot live your life inside of accounting, marketing, and so on. Understanding the technology that is underneath the hood of blockchain is important, either if you want to be an investor or if you want to develop a business around it. And then the second part that sometimes comes as a surprise to, say, our friends in computer science is that all problems are business, that designing a protocol is indeed designing a protocol that people will follow. And that is something that we have understood through the lenses of economics, operations research, and organizational behavior inside the Tepper School for since our roots and founding so many years ago. And so in part, if you sort of think about, these businesses that started in the .com era that were crazy, overhyped, they're going to change the world, and, exactly how they changed the world turned out to be different than how we might have anticipated it. But at the core is coming back to the business element, right? That eBay is an auction site. That's a technology, but it is the people that are doing the bidding. And so that's what I think makes it appealing as a researcher here, is it is at the core of understanding technology. And so our folks in computer science and Scilabs partner with us here at the Tepper School to dive into that. This is part of what we call here at the CMU a blockchain initiative. If you're wondering what an initiative is, an initiative is a center that is waiting to be funded. So, right, little initiatives start. We hope they eventually grow to become big research centers. But it is a place to try and gather up all of this, interest around campus. And so, you can't swing a dead crypto kitty around and not bump into somebody who is interested in actively working on currently starting up a business that has at its core blockchain. So I will stop there. And what we can do is we can bring in our esteemed panelists. So Ron Pavadek, Lillian Riesnor, and Steve Ehrlich are going to join us here. They hopefully are appearing on our screen in a moment. And then what we can do is I can try and ask each a question to get our discussion rolling. And then we have some questions that you pre-populated that I've tried to sort of condense down into areas. So let me start with Ron, and then Liliana, then Steve. And so how I thought I would structure these first three questions to help lay out the map was there's sort of two things going on in cryptocurrency that were partly underlying those two poll questions we had. The first is, will blockchain technology change finance, in the sense of this is the fintech era of is blockchain something new that might replace banks or financial markets or asset-backed securities? And then from there, we'll spin that towards Liliana and think about it as investment, and then we'll go to Steve. But let me start with Ron, which is sort of how will the growth and adoption of blockchain technology impact traditional finance?
Yeah, thank you. The impact of blockchain technology is clearly going to be broad across a broad number of industries, but within finance specifically, there's some very interesting areas of change that are coming about here. First of all, blockchain technology is at its heart decentralization. And that is completely counter to the way finance or traditional finance and Wall Street work today. So this peer-to-peer transactions is almost antithetical to Wall Street, which behaves in many ways, especially the sell side, as a third party, as an intermediary, and actually as even a gatekeeper. And I think that what you're going to see is an ability for participants to carry out transactions in what amounts to an unbundled way. So right now, Wall Street as a whole offers a whole range of services, and they essentially offer them together, both to institutional investors as well as to individual investors. And we're looking at an environment which I like to think of as the potential for the great unbundling, when all these services can be separated. And if you think about these services such as banking, stock trading, custody, stock loan, margin trading, all of these functions, which are essentially rolled up at individual institutions, we're already working towards these functions being carried out independently. And just as an example, take a custodian. We put our assets with a particular custodian, whether it's Bank of New York, State Street, JP Morgan. These custodians essentially control the assets or hold the assets for the asset owner. But a blockchain itself is essentially a custodian. I mean, a blockchain is the record of these assets. And what is likely to happen is many of these functions that Wall Street is carrying out, such as custody, those are likely to change, where the custodian maybe will be a key holder for the blockchain, and they will carry out those functions that way. And so they're going to change stock loan, margin trading. We're looking at DeFi with margin trading. All of this lending capability now can happen and at distinct components as opposed to completely bundled. We can go into kind of a lot more detail here, but I'm going to just leave it the general concept that we are likely to see significantly more competition in the various functions that Wall Street carries out, specifically because they can be carried out independently. So while fintech has provided has raised the bar for competition on Wall Street, I think what you're seeing with blockchain technology specifically is to raise that even further for a whole range of investors, in finance.
That is that's interesting. Like underpinning, if you think about a bank and all the different functions of a bank, it's really tied up with record keeping, the making of a loan and the record keeping. If you can separate the record keeping and you just do loan making, what's it look like? And that's sort of the example of this disintermediation or unbundling that is possible. Whether or not it's going to be economically feasible or happen is certainly really interesting. So let me spin for a second. So the other thing that's going on with blockchain, which is related to any time you have technology and new technology, is can I make any money at this? Which is the finance investing side. And so turning to from the sort of, how will blockchain change finance? Let's think about how we apply finance to the outcomes of blockchain, which is so this is for Liliana. How do you analyze cryptocurrencies from an investing perspective?
Thank you. First, you need to understand that there are many cryptocurrencies currently. There are more than 3,000 cryptocurrencies trading in more than 300 crypto exchanges globally. To be able to analyze them, you need to put them in categories. At Suprafin, we categorize them into exchange tokens, utility tokens, stable tokens, and security tokens. Exchange tokens are those cryptocurrencies that are linked to a particular public blockchain, where these exchange tokens are used as a medium of exchange in their particular blockchain and are used as an incentive mechanism to maintain their public blockchain. For example, Bitcoin linked to the Bitcoin blockchain, Ethereum linked to its own blockchain, Litecoin linked to also Litecoin blockchain, etc. There are hundreds of these exchange tokens. Then we have utility tokens. So those are cryptocurrencies that are used to access current or future products and services. And they are also used for discounts of products and services. Then we have stable tokens. Those are cryptocurrencies that are backed usually by a stable fiat like the dollar or like the Swiss franc. And last but not least, we have security tokens. Security tokens are those cryptocurrencies backed by any security. Currently, there are not many security tokens, so that's something that might come in the future. But these security tokens will reside in a blockchain, as opposed to currently there are a lot of products linked to equities and securities that don't reside on blockchains. With regards to the exchange tokens and utility tokens, their business models are completely different than the business models of equities and fixed income, in that they don't rely on cash flows linked to companies and to P&L, to profit and loss. They have their own unique business models. The business model of exchange tokens, it really relies on the understanding of their underlying public blockchain. And the ones of utility tokens, that's much more complex because every type of utility token has their own business model. And I include some of the decentralized, the DeFi solutions in utility tokens. Although I will say exchange tokens on their own I will be considering, in my opinion, also decentralized finance, because they provide decentralized payments. They are like a parallel system to the banking system, but they're not related to the banking system at all. So once you have those categories, then you need to develop the investment framework, determine what are the parameters that drive the value for each of those types of cryptocurrencies. In the case of exchange tokens, you need to understand the business factors that affect their particular public blockchain. For example, level of decentralization, security, and so on. Obviously, all these cryptocurrencies are traded. So another parameter that is also important is the market parameters. And in cryptocurrencies, you will see volatilities in non-stable tokens or non-stable cryptocurrencies. You are going to see volatility that ranges from 25% daily annualized volatility to 250%. Obviously, that's quite high, but this is a new market, and so this volatility is you're expected. This is expected. You can think of the equity markets and fixed income markets when they were created hundreds of years ago, and I'm sure the volatility was very, very high because there is uncertainty. Not everyone agrees on how you are going to evaluate them from investment purposes, and also there's less participants. They are more illiquid, and so on.
So that's a nice summary of those, and we didn't even get to CryptoKitties yet, right? The non-fungible tokens we can come back to.
That's a great point. So I didn't include the non-fungible tokens because I cannot even put them the non-fungible tokens in any of those categories. So all of a sudden, it's a new category on its own. They reside obviously on the Ethereum blockchain. But it's a very unique business model. I cannot even say that it fits within the utility token business model. So it's more.
I think the issue is whether or not it fits in within sanity. I think is what we are still trying to figure out. So let me see if I can get Steve in here. And so Steve has his background at Kraken, which is a big exchange, and so an irony of Bitcoin and blockchain is that this aim towards decentralization of sort of example, Bitcoin has blossomed with a whole bunch of these very centralized exchanges. And so this decentralized exchange of Bitcoin that is owned by no one, for the most part, lots of these cryptocurrency exchanges we're trading liabilities on this exchange, not directly the Bitcoin. So Steve, why don't you jump in and give us your sort of perspective from both your background as well as a director of digital asset at Forbes. What's your take on sort of blockchain kind of, as a finance thing, or blockchain or as blockchain as a finance investment?
Yeah, no, thank you for that. It's kind of funny. I'd like to just start by just sharing a brief story. I mean, I was on a panel discussion a couple of years ago, and one of the questions that I got, or the panel got, was essentially, what are you most looking forward to when it comes to crypto and blockchain? And a lot of people gave typical answers. The individual financial sovereignty, so on and so forth. And one person gave an answer that I loved. He said, I'm looking forward to the end of blockchain conferences. I mean, he said, we no longer have spreadsheet conferences. We no longer have conferences on the relational database and core banking systems and so on and so forth. And I think at some point at maturity, this is all going to get merged into one. I mean, we don't separate out like core banking stacks from payment systems. It's all part of the financial system. I think enterprise blockchain as pertains to capital markets, and some of like the open asset protocols have developed independently. And I would imagine my panelists would agree that they've seesawed over the years of which one is sort of more prominent. And but with all of us sort of agreeing that at some point they're going to meet in the future. And I think we're starting to see this. I mean, big banks like BNY Mellon, Deutsche Bank are starting to develop their own crypto custody solutions. The Office of the Comptroller of the Currency has issued national banking licenses to crypto firms so that they can offer certain types of banking services. Goldman Sachs just announced that they're going to be restarting their trading desk. Morgan Stanley is the first major Wall Street bank to directly offer exposure to crypto for their clientele. Granted, some of the more affluent ones, I think they have to have a minimum of $5 million at the bank and have had to hold that for at least 6 months. But we're starting to see that that sort of convergence, and so I'm looking forward to what this is all going to look like at maturity.
Yeah, I'm thinking back to at one point we had a short program which was a master's of, I think it was a master's of e-commerce that was, and your point is spot on in the sense of, that's really stupid now because, it's all e-commerce, right? That's your business has a web page, your business has, storefront, and there's some component of those. And I think that's part of the interesting issue as to which parts of this will eventually become the core technology that we won't discuss and debate anymore. There's sort of a host of places to turn to, but sort of one that is kind of looming, and it's a hard issue, which is to sort of ponder how regulation will look in this setting. And it's difficult because of blockchain is inherently sort of multi-jurisdictional. It is a bit Wild West, and it is a bit confronting established banks, which might have the ear of regulations. So I'm trying to think about how to phrase this question other than, take the Q regulation and spin with it, but give some thoughts as to what do you think of as the role of regulation? Ron, do you want to start that?
Yeah, absolutely. Given that our client base at Symbiont are large financial institutions, we have not been able to avoid discussions with regulators, and that's a critical component of everything that we do. As a matter of fact, I've actually demoed our platform to the SEC, and they were very interested in how blockchain technology can actually improve and facilitate their work. So one of the most obvious areas is that you can imagine a scenario where regulators run a node on the network and they're able to monitor in real time. Compare that to what happens today when they're required to do, go into a firm's offices in order to do an audit. Well, they could actually monitor in real time. They could write smart contracts that identify accessions or at least trigger warnings and get access to payment flow transfers. So there's a whole kind of area just around monitoring. But there's another aspect of it too. When we talk about using blockchain, for example, within the private equity world, there are restrictions, for example, that don't allow transfer of assets within 365 days, the first year that you hold an asset. Well, all of those type of restrictions can be programmatically encrypted or encoded into the smart contracts. So you would be unable to transfer those assets unless it complied with a particular set of rules and regulations. So from a regulatory perspective, there's huge opportunities with blockchain technology. And I think many of them kind of stem from just around the areas of transparency, just being able to communicate and be aware of what's happening in the industry, what financial transactions are getting carried out. And that monitoring is something that regulators are actually very excited about. And I think most participants in the industry, active, investors would be very comfortable with that as well, as given what the alternatives are, in the regulatory environment.
The phrase "excited regulators." I'm trying to figure out whether that's a good or a bad thing. Right? It looks like the title of a movie. Tepper historical footnote here. There is a famous paper by Finn Kidlin and Ed Prescott, two of our economics colleagues, who go on to win the Nobel Prize. One of their famous papers was called Rules versus Discretion, which was about how do you design monetary policy? Do you design it to be reactive to what's going on in the economy, or do you have rigid rules? And the answer is, it's complicated. Part of the reason they win the Nobel Prize is that people have been arguing about this for a long time since. What's interesting about smart contracts, for example, is that there's a whole new way of being transparent and rule-based commitment. So you can write your Solidity code, post it to the Ethereum network, pass the ownership of that contract to the contract itself, and you can't touch it. It is a commitment which is transparent and firm in ways that I don't think that Ed and Finn would have thought about back in the day. Liliana, do you want to chat a bit about how you dance in the regulatory waters? I'm not too sure. I'm sorry, that's probably an awful metaphor. How you navigate anyway. Pick your metaphor.
Well, I believe in the UK, the FCA does not regulate exchange tokens, utility tokens, and some stable tokens. They only regulate security tokens because they are considered securities and all security laws apply to them. However, the UK does require company exchange tokens, crypto exchanges, custodians, and other companies doing business in crypto to register for anti-money laundering. Which is okay, but then when you see financial institutions can now deal with cryptocurrencies, and because there's no regulation, and probably they don't have to register with the FCA either for anti-money laundering because they are already an existing institution. I know so SupraFin as an investment advisor platform or a robo-advisor for cryptocurrencies is not regulated from the advisory perspective. Now, in the US, I understand that all custodians and crypto exchanges are regulated. However, a platform like SupraFin, which is just a recommendation platform, will not be regulated as long as they only have exchange tokens, because I understand utility tokens in the US are considered securities. Obviously, that narrows then, that will imply for SupraFin we need a broker license to move into the US to also include what are called the utility tokens. And regulations in other parts of the world, are different in other parts. But so far in the UK, SupraFin can offer the services to retail, and is not considered a financial advisor, or because these cryptocurrencies are not considered securities. However, in the future, as we add the security tokens, we will get the appropriate license. But currently, security tokens, there are not many of them, probably because they are regulated. But in the future, as I think companies get the right licenses, they become more prevalent. But also, I think security tokens cannot thrive in this market, especially if they are offered to retail, unless there are proper asset management platforms that can properly evaluate it. To me, any cryptocurrency is like a complex product. My background is on that, on trading and analyzing complex finance products. And they are complex, not necessarily the way we will think of equities or fixed income, but they are complex to analyze. You need to understand the blockchain, the methods, how the link of the value of the token versus the blockchain, or in the case of utility tokens, where is the value coming from? So that is a new business model, and most people don't understand that. So until you have more platforms that can do the asset management, it's unlikely to see that this market will thrive really at the retail level.
I think one of the things that is interesting to ponder is this SEC. Is it a security? Is it a utility token? Is a very sort of interesting. What exactly is your crypto digital asset a claim to? Is, I think, partly related to this issue of valuation. Steve, you jump in?
Yeah, sure. So obviously there's a lot that we can talk about as it pertains to regulation. From the perspective of my role as the director of digital asset research at Forbes, I'm more interested in regulation as it pertains to crypto assets. And I tend to break it into a few different categories. For one, there's sort of the anti-money laundering, know your customer level, essentially trying to prevent bad people from using crypto to illicit ends. And this is common around the world. And I think most of us are starting to get comfortable with that. And people in the industry, except for some of the more ideologically driven towards it, understand that this is necessary for general adoption. The more interesting discussions focus on, as we're talking about the SEC, what constitutes a security? Essentially, does it meet the Howey test or not? And then also some interesting discussions pertaining to market infrastructure and capital formation. I mean, most exchanges in the U.S. They're not registered at the SEC, so they can't list security tokens. So anything that the SEC suggests is a security, they really have to delist. And you saw this when the SEC actually sued one of the biggest cryptocurrencies in the world, XRP, closely affiliated with Ripple, and they're alleging that one of the ways that Ripple was donated billions and billions of dollars of this when it was first created several years ago, and the SEC is alleging that Ripple has funded its activities mostly by selling XRP, and they say that this constituted an unregistered security sale. I actually interviewed Ripple's CEO a couple of months ago, and I mean, they pushed back and they explicitly say that XRP is not a security, but I guess that will be up for the courts to decide. But aside from that, I mean, Bitcoin has been deemed decentralized enough to not be a security, which is one of the core tenets of the Howey test. Ethereum or Ether, its native currency, the same way, which is why you're also seeing listed on exchanges and regulated derivatives exchanges like the CFTC offering futures in Bitcoin and ETH. And then the other part related to regulation goes to the heart of what a lot of people in the industry are hoping for this year, which will be the creation or the approval of a Bitcoin ETF. There's been dozens that have been rejected so far by the SEC, mostly on grounds that the market is not free yet from fraud and manipulation. There aren't good enough information security agreements among exchanges around the world, and it's just too error prone so far. We just saw a whole suite of new ETF applications sent to the SEC, headlined by Fidelity, which sent one yesterday. And my personal belief is that Fidelity, I don't think, would apply for one if they weren't pretty sure it was going to get approved. So we'll see. I actually had a conversation with an SEC commissioner, Hester Peirce, who was appointed by Trump, I guess 4 or 5 years ago, and she's dissented to a lot of the Bitcoin ETF projections because they feel that Bitcoin is being held to an unfair, because she feels that Bitcoin is being held to an unfair standard. But as institutional adoption of Bitcoin grows and we see these regulated players dedicating millions and billions of dollars to the space to build out infrastructure, I think a lot of people are optimistic that we will see an ETF this year.
Awesome. There's like a host of questions in our chat and questions, so I don't want to manipulate them all by choosing. Let me see. So one that has popped up that's related to regulation that's interesting is to think about what the role of a central bank is, and particularly the one that you see asked a lot is, what do you think of a central bank digital currency? Is that something we would see at the Fed or other digital banks? Stephen, do you want to take that first? We can go to
happy to. So this actually is a nice corollary to what I was just talking about, because one of the other fears as it pertains to regulation is whether or not Bitcoin and crypto will be banned, because there's a lot of smart people that feel that sort of the administration of monetary policy should be the domain of sovereign nations. Aside from that point, though, CBDCs or central bank digital currencies have really become a hot topic. For a couple of reasons. One, people got excited about Bitcoin and crypto, but I think as Liliana was referring to as well, the underlying volatility of these assets just made it impossible for them to really work as a form of money or payment system as currently constituted, even if that was sort of the central idea behind Bitcoin. A few years ago, some people created something called a stable coin, which essentially is a digital asset that runs on top of a blockchain pegged to the value of an underlying asset like the dollar, euro, pound sterling, et cetera. But in some ways, this was kind of like a Band-Aid measure, because a lot of these are run by companies that take dollars under custody, issue a digital asset on a blockchain, and by far the biggest one, Tether, which I think has a market cap of must be close to $40 or $50 billion. There's some very real questions about whether or not it's actually properly collateralized. all that said, we're moving into a world of digital commerce, e-commerce. People don't understand why it's so hard to send money around the world, and they think it should be just as easy to send money around the world as it is to send an email or text message. And central banks recognize this fact, and they've gotten to work on building essentially a new digital forms of money that will run on top of new tech stacks that should hopefully improve efficiency, build up the economy, and I think will dovetail very nicely with this this growing shift towards e-commerce and electronic payments. There's a lot of questions, design questions that have to come out, like will these actually run on top of blockchains or not? How will they be interoperable with systems around the world? How will we manage privacy, security, et cetera? But I'll stop here because I'm sure everyone else has some other questions about it too, or thoughts, I mean.
Yeah, I'll just add one point to this, and that is that right, the value of Bitcoin is not just the value, right? I mean, and as actually, Brian, when you opened up, you highlighted the decentralization, you had the ledger and competition. Well, the ledger is the value that the central banks are really looking for right here, and the fact that they can have a record of this and of all transactions, and I think that is something that is clearly very valuable. That is, I would say, opens up the door to a lot of things. For example, taxation. There's a whole there's things that I think that don't even exist in today's currency that could become part of the kind of the framework. And I think this is certainly a kind of open the eyes of the central banks.
Yeah, and I would like to add something there. These digital cryptocurrencies by the central banks, interestingly enough, very likely they will follow the old economic model they have. So let's say the US issues their own digital currency. How are we going to value it? It will be just like the US dollar, correct? And we will use all the economic parameters that we use because they are not a decentralized ecosystem like what Bitcoin offers, Ethereum, or whatever. They're not decentralized blockchains. So to me, they will compete with the stable coin. So maybe the stable coins will go away. And instead of me using a stable coin or investing on that, if I want some stable coins, I'll just have the cryptocurrency of the US that represents the US dollar directly. They will be complementary, and I don't think they really compete at all with what the current cryptocurrencies like exchange tokens do. Because again, exchange tokens are a parallel system to banking that have nothing to do with it. And actually, it's good that they have volatility because if you want to invest, you don't want to invest on something that is flat forever, correct? So you want to use a stable token for payments, and sometimes as a hedge within your diversified portfolio, but also the other cryptocurrencies. Because of volatility, you can have returns. If you have low volatilities, then you will also have low returns.
I was pondering on Ron's deep irony is if blockchain technology makes it easier for the government to tax everyone, that would be one of those definite unintended consequences, I think, of Satoshi Nakamoto. I don't think that's what he/she was aiming for when introducing blockchain, which would be, I guess, partly why central banks might be interested in this. So let me ask about non-fungible tokens because they're in the news now. They're kind of they're a thing. They have bubbled up in the way, I guess, if we'd done this a year and a half ago, we might have been talking about ICOs or some other three-letter technology. But maybe Ron, you might be the one that'd be able to ponder on this, because in some sense, the non-fungible tokens are basically a digital asset that we can create and offer you. I have indeed, here is a unique set of numbers you can own. In some sense, that's related to some of the back office issues you're thinking about how it would relate to finance. So I'm not too sure exactly what the question is, other than are non-fungible tokens crazy, or is there something interesting there?
Well, yeah, I think a lot of people are looking at non-fungible tokens and they're saying, look, there's no value here, but they're saying that in the context of just this individual token, and what gives any asset extrinsic value is society, its brand, its culture, and its society determines value. So whether it's a baseball playing card, whether it's art, the fact that we all enjoy looking at the Mona Lisa is why the Mona Lisa is valuable, and it's a societal value that is being applied. When we look at NFTs, there's a question like how much societal value have we ascribed to this particular asset? And the answer is so far, perhaps not that much, but that's really what it's capturing. It's whether it's a current zeitgeist or whether it's a longer term kind of societal view. But baseball playing cards, all these things have value significantly in excess of the paper that they're printed on, and consequently, and the value to those is determined by a minimum of two parties that believe it has that value. And so right now we are in a period where there are at least two parties believe every NFT has some value, and consequently we're seeing these things drive up in value. It's hard to value them on an absolute basis, but as a society, we are granting value to this based on the kind of almost a cultural time. Yep. This may change. I was going to say, Beanie Babies still have value today. And if you can assign value to those, it's hard to say that NFTs are any different.
Pet Rock, Pokemon Go. Yeah, they're all the same. My favorite, this is not a question, but Steve Garber's comment in the chat was whether or not you view crypto as money or not is correlated with whether or not you are above or below 40 years old. And I won't speculate as to what sign the correlation might have. So Liviani, we mentioned NFTs earlier. They do not currently show up in your robo-advisor?
No, so because NFTs are mainly used for art or digital content that is again valued by this particular person that is interested in owning them, like they will own a piece of art. Yep. And so that's a category that, that we will need to have an expert on art to probably be able to help us with that. And we'll rather just focus now on the other type of cryptocurrencies. But
there are finance academic papers that try and put art into your mean variance portfolio analysis, if you would like to know. And I'm suspicious that it's the same people who put wine in their portfolio, and they're looking just to drink it.
Just to clarify, when you on our investment analysis, other than the market metrics and this mean variance or whatever, there's also the other more important component is truly understanding what it is that you are valuing and understanding the market for that. Correct. Mm-hmm. And so the art market, you need to understand it truly well. So for us to try to speculate on that, at this point, it wouldn't make sense. We'd rather focus on the other cryptocurrencies, which we understand well how to analyze, and we have a framework.
Steve, do you have a perspective?
Yeah, I mean, just quickly on this. NFTs, whether or not they pertain to art or highlight clips of NBA players or anything. I mean, right now these are still highly illiquid assets. I mean, the analogy I give is even if you have two pieces of real estate that are exactly the same, they're in two different locations. So beauty is very much in the eye of the beholder when it comes to valuation. For the research service that I run and for investors who subscribe to my reports, I mean, obviously, the gains on NFTs and some of these like $69 million digital painting, that'll get everyone's attention. It was on the front page of the Wall Street Journal. And so they're interested in ways to invest and profit from it. I tend to tell them not to spend too much money on NFTs because they are so illiquid and there's no guarantee you'd be able to sell out. But one thing that most people don't realize is that all these NFTs have to sell on marketplaces that run on top of blockchains, most of which are Ethereum. They have their own application tokens like OpenSea and Rarible and Flow. And those, you can invest in those tokens. They're more illiquid than Bitcoin or Ethereum, but at least you can trade them. You can see what they're worth. So for people listening that might want to think about ways to get a little bit of exposure to the space, but are worried about not picking the right digital collectible, that's one way to do it.
Yeah, that's a good spin into sort of the next question more generally, which is, do you have advice for folks on how to think about investing in this asset, in this thing?
Yeah, I mean, one of the things I would say is you have to figure out what type of investor you are, what your risk profile is, how much money you're willing to put up. I mean, some people, crypto curious, they could be retirees. They have a little bit of excess money. They're looking for a way to diversify their portfolio. So they might put maybe 5% of their assets in Bitcoin, take a flyer in that. Once they get more comfortable, perhaps then they'll put a little bit of money into Ethereum, which is sort of like the next step. And if you want to wade out into the deep waters, then you could look at all types of Ethereum killers and NFT tokens and DeFi, which we haven't even really talked about. And but it's a very individual decision. The one thing that I would keep in mind are two things. I mean, for one, the market still is very highly correlated. Everything almost correlates to Bitcoin. So Bitcoin is really the straw that stirs the drink. And two, I mean, I believe in it strongly. I mean, I've dedicated my professional career to this space, but it's still volatile, and it can still, there's still a non-zero chance that it goes to zero, everything. So if you are going to invest, which I do think people should, just make sure you don't invest more money than you can afford to lose.
Well, I would say, since my company specializes in investing in cryptocurrencies, other than NFTs, which we don't include, you need to invest like a professional. So there are a few hedge funds, people that come from finance, a lot of used to work in structured credit, create some hedge funds out of New York, and have teams doing proper evaluation of these cryptocurrencies, selecting the best. Sometimes the best today might not be the best tomorrow, trying to pick the winners. So last year, so we have a lower risk portfolio, medium risk portfolio, and high risk portfolio. Even my lower risk portfolio, which has a lot of stable coins, had a 90% return last year. My high risk portfolio had around about 100% return. And this compares to, for example, one cryptocurrency, and EOS had a -6% return. That's just one, but there's many of them that were rubbish. So why do you want to just pick something that you might not know? I mean, if you want to gamble, sure. But if there are platforms there that can help you invest better, why shouldn't you do that? So obviously my platform, Suprafin, does that, helps people invest in cryptocurrencies in a diversified way, but in a smart way. But there will be others as well, correct? The investment management and asset management component is a very important component, and especially in a market which is very complex and is quite new, with high volatility, great potential, but also with great potential losses.
Ron, you want to jump in there?
Sorry, I'll just get one point on investing in diverse assets. And, you know, we have come as people have become comfortable investing in a little bit of everything. They buy the S&P 500, they buy 500 different stocks that they don't know anything about, but they're weighted by market cap, or they buy a world index and they get exposure to a bunch of different countries. And all they're trying to do is to get a market cap weighting. If you believe in that, it seems reasonable that you would want some exposure to cryptocurrency. Granted, it's relatively small now, but that would fit into the exact same framework of thinking. Not to mention the fact that I think I tend to believe that the risk-reward profile is skewed and relatively positively, especially given the correlations. It is a diversifier for a portfolio.
Good. I'm glad we pitched the diversification. As a finance professor, I would be kicked out of the union if we didn't mention diversification. I was a little worried with "take a flyer" as a phrase. So we are pressing up on towards the end. So I'm trying to think of a rapid fire question that's really, but I don't have a really simple one. So we have this webinar 5 years from now. Do we have this webinar from 5 years? Here's the sort of yes/no with a quick why. We reconvene in 5 years with this same topic. Ron?
I think that blockchain will be significantly more prevalent in its use, but we're not going to be talking about blockchain. It's just like we don't talk about iOS, we talk about the applications.
Okay. Liliana?
Well, I think we should reconvene in 1 year because cryptocurrencies change so fast. Like non-fungible tokens, they just became now more prevalent.
That was like
the
last
concept
week.
of correct DeFi, decentralized finance, which also became more prevalent within the utility tokens concepts, and there are all kinds of things. So there's lending now, lending offers through this DeFi. So I think this market is changing so fast that in 5 years, who knows? Maybe in 5 years, security tokens will also become a bit more relevant. Yeah.
Steve?
I would just say yes, and hopefully in person or probably through some sort of virtual reality device, either or, but hopefully in person.
I think we should book it 5 years from now, and I will buy us all a beer.
Yes.
I will take $50 and stick it in cryptocurrency, and I will buy you all a beer or a Ferrari, depending on how well it works out. Yeah. Anyway, thank you all for that. This was it's a big topic, and this is not the most friendly of mediums in Zoom, but it is what we have, and I really appreciate the chance of getting together. It's nice to get together with you. It's nice to get together with our community. And John, thank you for bringing us together.
Well, thank you all for joining us today, and for our alumni audience. We know we couldn't get to all your questions, but we'll send you out the contact information of our speakers today, and they are the experts, so they'll be happy to follow up with you as we build our alumni community and make it stronger around the globe. So thank you for joining us. Hope to see you again soon. Thank you to our panelists for investing your time with us today and with the alumni community at Carnegie Mellon and the Tepper School.